It just happened. The Federal Reserve finally raised interest rates after a multitude of years. How is this going to affect you? How is this going to affect you in the financial industry? What is this going to correlate to? What does this mean overall as an investor? Again, this is going to affect you in every single aspect of your life. When you're buying a house, when you're buying a car, if you have any student loans, your credit card interest and payments that you're going to have to make. What does this mean? Let's dive into this right now. The Federal Reserve approves its first interest rate hike in more than 3 years and sees 6 more ahead. Now, what are these going to be? These are going to be about a 25 basis point increase, and there's going to be about 6 or 7 of them. And the reason the Fed is doing this is because inflation has been increasing at a substantial rate. And the reason they want to increase interest rates and get them above that 0% is that way people are borrowing less money, and to borrow money it becomes more expensive, which will help lower CPI, Consumer Price Index, and inflation overall. Now, before we dive into how you can benefit from some of the data I'm about to share, what you need to know, and how this is going to affect you moving forward in the later of this year and the multitude of years ahead, please make sure to smash that thumbs up button down below. Make sure to subscribe to our YouTube channel if you've not done so already, and leave a comment down below how this is going to affect you and what your opinions are about this video and what interest rates mean for the economy overall. Are you bullish or are you bearish given this information? All right, furthermore, let's dive into this right now. Again, this is going to affect home prices, loans that you're taking out, the stock market and the equity market, your credit card and your payments on your credit card, and student loan debt and how taking out your student loans. Again, the reason this is because it all ties back to the federal funds rate. Now, the federal funds rate has been at 0% ever since 2020 when we entered the pandemic. And the last time we saw the rates increase at quite a bit of a substantial amount was in 2018 when rates were at a peak of 2.5%. So again, why are they doing this? Why are they raising interest rates? What does this mean overall? Now, the reason they're doing this is because inflation is actually at a 40-year high as pressures continue, on the consumers, and Fed and Biden and especially Jerome Powell are going to have to, effectively decipher and, figure out inflation in order to lower it so consumers aren't having to pay such high substantial prices on the prices of goods and services. So again, the Fed approved a 0.25 basis percentage hike rate, and it's the first since December of 2018, again, or 25 basis points or 0.25% as they go by it from the Fed. Now again, Jerome Powell has been printing out a lot of money, and with CPI increasing at about 7.5%, the highest since 1982, they're going to have to raise interest rates to control inflation overall. Now, why is this happening? Now, what happens is when the Fed fund rate increases, banks have to pay more. And when banks have to pay more after the Fed fund rate increases, this increases the prices, which makes it more expensive for you to increase and take out loans, which is, going to affect you in a multitude of ways. Now, one of the first things we're going to talk about, how it's going to affect you positively and negatively. One of the things that is going to affect you positively is banks are actually going to be paying you a higher interest to store your money. Now, the reason the banks are going to be paying you a higher interest rate to store your money is because with the Fed increasing rates, banks are going to have to be competitive in order for you to put your money in the savings account and keep your money with them. Now, right now, current banks are paying about 0.02%, 0.01%, such as Wells Fargo, US Bank, Chase, TD, Ameritrade Bank, and others. But when they add and they increase these interest rates and increase the hikes, 0.25 basis points 6 or 7 times, you're going to see that you're going to be earning more money from your savings account, which is one benefit. Now, don't expect to get rich off this, but it is something that's positive that's going to come from interest rates being increased. Again, why are they raising interest rates? Because of inflation at such a substantial amount. So the first thing is savings accounts. It's going to positively impact your savings accounts, which is positive, which is good overall. And again, this is the first time that they've raised rates in more than 3 years. So it's going to take time for the economy and for people to really get a mindset of how this is going to affect things overall. Now, again, you can already see right now, Bank of America and some other banks are starting to show you what their interest rates are going to be. And one example of this is actually Nationwide Building Society offers a competitive account with a 2.5 interest on savings. Okay, so we have banks. Now, how is this going to affect the equities market? Typically, people think, okay, when they raise rates, that's bad for the stock market because people are borrowing less money. Now, typically that is normally true, but if you dive dive into some of the data and the research, according to Data Trek Research, the S&P 500 has only had 2 losing years since 1990 when the Fed was raising interest rates. A 9% decline in 2000 and a 4% drop in 2018. That leads the firms to believe that there's not a negative correlation to an increase in interest rates to the stock market overall, which is good to keep in mind. Again, this is some more data and some more charts that shows, even with them raising interest rates, it's not going to negatively affect the stock market as bad as people anticipate. So that is the second thing. And based off this slide right here, you can see every single time they've actually raised hikes and they've raised interest rates, the stock market has continued to prosper and increase overall. Another data on this is since 1995, in months when the U.S. 10-year Treasury yield rose by more than 50 basis points over the following 3 months, the S&P 500 actually had a price gain of 3.2%, roughly 100 basis points higher and a higher return than that of the typical month. So that's something to keep in mind. And on the bullish front, here's a chart that shows the S&P 500 on average has gained roughly 20% in a rising interest rates period since 1971. And actually 1971 was when President Nixon took the dollar off the gold standard. And that's when cash became trash. And that's why here at Brotherhood Finance, we preach so much about investing in assets and obtaining financial education. That way you can invest your money since they are printing money out of thin air. As we can see, we're having the highest amount of inflation since 1982 at 7.5%. So that means if you were to save money, you're losing 7.5% of your US dollar. Now, it is important to keep some cash on the side for buying opportunities or buying assets, but it's important to really develop that right mindset and have the right education to be able to invest your money. That way you can achieve financial freedom. If you've watched so far, please make sure to smash the thumbs up button if you've not done so already, and subscribe to our YouTube channel. Let's continue on with how this is going to affect you overall and how you can prepare and benefit from interest rate hikes moving forward. Okay, so the next thing we're going to be talking about is what is going to benefit from this. So sectors such as banks, industrials, semiconductors, they usually tend to outperform as rising rates go higher with an improving economy overall. Now, the next thing we're going to be talking about is the housing market. How's this going to affect housing prices? Now, if you look right here, the housing index versus interest rates, you can see as they've raised interest rates over the long term, the housing prices have still considerably gone up quite substantially overall. So that's something important to keep in mind. And if you dive into some of the data, although it's going to be more expensive for you to take out loans, especially on a larger loan and a larger asset class, such as a home, you're going to have less purchasing power, and the leverage is going to cost more money to get a loan on. However, there's not a tight fit at all between the two. High mortgage rates do not translate automatically into low home prices. So that's important to keep in mind. Now, how else is this going to affect you? As we first mentioned at the video, so we talked about how it's going to affect housing, how it's going to affect the equities market, how it's going to affect loans in general, how is this going to affect credit and loans in that essence, and student loan debt. So just some information. We're going to be talking about credit card debt and how that's going to affect debt. Our researchers found that the median debt per American family to be about $2,700, while the average debt stands at $6,270. The average balance for consumers is $5,315. So that's important to keep in mind. And 45.4% of families actually carry some sort of credit or credit card debt. And 40% of millennials, which is the younger generation, say credit card debt is actually their biggest financial burden or setback, which is what surveys are finding. And again, which we talked about in other videos, the average millennial carries about $28,317 in debt. So what is this going to mean? Now let's do an example for this. So when they raise rates, you're going to see people in these credit card companies raising their rates overall annually, if you're taking out credit card debt. So let's do an example, $28,000 on average debt at a 3% increase based off, them having to increase rates 25 basis points 6 or 7 times. That's going to increase about 3%, which is going to cost you about an extra $80 per month, which doesn't sound like a lot, but that actually adds up quite substantially over time. And again, for credit card interest rates, you need to expect to see the first jump on March 16th. So these are already going to affect. You're probably going to see credit card interest rates increase overall. And it's going to depend on how many times the Fed does decide to increase and have these interest rate hikes. So try to pay off your debt on time, try to pay it off, try not to take out as much debt, or if you do it before they continue to rise interest rates. And as far as student loan goes, they're also most likely going to have to increase. Typically student loans have been at 0%, but again, with the Fed increasing rates, they're going to most likely have to increase the interest at which you are getting charged on your student loans. So that's also something to keep in mind, and that's why one of our things was try to stay out of student loan debt if possible, or at least invest in an asset vehicle to increase your returns to keep up with inflation, and park your money in some sort of essence instead of being in debt. All right, so again, let's follow up. Let's gather all this information together. Again, the markets anticipate a 25 basis point rise, which the Fed has already put into place, but pricing has risen to indicate about a 70% chance of a larger 50 basis point hike at the meeting, due to concerns of inflation. Is this going to happen? We're not sure. I hope that we just continue to follow these 25 basis point hikes. That way we don't get rug pulled in the market and people can really price in all of these increases in rate hikes. I hope you found value in this video. If you have any questions about interest rates, how what it means for you overall, if you found value in this, again, please make sure to smash the thumbs up button. Make sure to subscribe to our YouTube channel. Leave a comment down below. And I appreciate you watching all the way through this video if you have done so. I hope you found value in this. Again, have a good rest of your week. Have a good rest of your weekend, or a good rest of your day. I appreciate you watching all the way through. Much love. Peace, brothers.